Live from Colorado Springs, I'm Diego Sanchez, president of HousingWire, and I'm joined today by Jennifer McGuinness, CEO of Pivot Financial, and also sponsor of our Vanguard Forum yesterday.
Very true.
Amazing. Jennifer, thanks so much for joining me today.
Absolutely, happy to be here.
So before we dive in, could you just briefly introduce Pivot Financial and what you do with lenders?
Yeah, I mean, at the end of the day, Pivot should be thought about as a lifecycle platform. So we're very tech-driven, but where most lenders become disjointed or most investment management companies become disjointed, we have a full lifecycle platform. So what does that mean? We have an aggregation platform where we buy non-agency loans, and then we also are a due diligence company that also specializes in breach defense and litigation support and also default oversight. So all the things that can go wrong, one side of our business, and we help you fix them. Things that go right, new origination, we have it on the other side, full life cycle.
Full life cycle. And so right now, it's a little bit of volatility, right? A little bit of uncertainty. We have the tax bill that's going through Congress. We have GSEs potentially exiting conservatorship.
Yep.
We have mortgage rates staying higher for longer than I think anyone would like. How are you managing your business with all of this uncertainty and volatility?
So I think that everybody's focusing on the uncertainty and volatility instead of what's the opportunity, right? And I think especially on the lender side of things, if we could get the lender mindset shifted to what's my opportunity instead of am I going to have a mid-size refi boom? Am I going to be able to pick up some more people? Educate your loan officers, get them into diversified products. I think we are still too stuck in an agency world, and we really need to start peeling that onion back in order for the lenders to really succeed.
It sounds like you're advising the lenders that you work with to flip the script, right? Like it's not volatility and uncertainty, it's an opportunity.
No, it's an opportunity, but it's and the other thing is listen, everybody's talking about AI and everything else, but have your loan officers be the expert at your products. When they're the expert at a product and the entire suite of your product, as soon as they hear a borrower buzzword, they're going to go, you're a perfect fit for this.
Yep.
You're a perfect fit for that. And I think that makes your funnel speed up, and then it gives you more closed loans. And I think that's what everybody should be striving for. A lot of our clients are closing record months right now, whereas a lot of people are saying this is a tough market.
So how is that happening? What are specific strategies that they're deploying and that they've worked on with you to help them to record months when others are struggling?
Well, some examples are really being able to do some predictive analytics on what borrowers would qualify for before people are on the phone.
Okay.
So being able to take, even if it's borrowers you've done loans for before or you're buying data, refreshing certain characteristics and putting credit overlays on top of that to say, fail, pass on products, and then look at what's the benefit to the borrower. Now you've got an empowered loan officer really making a call and saying, hey, I noticed this about where you are in your stage of life. This is what I'm seeing. The product you're in does this for you, but this is a product that can do that for you, and it's a benefit to you. And I think that's really important before a loan officer picks up the phone.
You've brought it up once. It comes up in almost every session here at the gathering. Artificial intelligence, AI, it is here.
Absolutely.
And but there are some lenders that maybe are scared of it, cautious about it, and for whatever reason have not dipped their toes into those waters. What are you advising those folks in terms of starting to play with AI?
Well, I mean, anybody who says they haven't dipped their toe into AI is lying to you. And the reason for that is just put anything into Google in a search engine and AI is talking to you every day, right? I don't think lenders should be afraid of AI. I think they should consider where they can deploy it and then how to control how it works within your organization. You don't necessarily, without sufficient testing, want to have that become your finite underwriting engine or be speaking to your borrower. I actually thought today, I saw it on the stage here, Total Expert's voice for their AI bot was pretty amazing. It actually sounded like a human. And I thought that was really cool. But I think there's that too. I mean, who doesn't call their airline to change a flight and get annoyed with the AI? I think it's really getting it to be that interactive conversation if you're going to use it there. And in some cases, if everybody goes to that, the lender who's going to win is going to be the one with the real human on the phone as well. So I think you need to really understand what business are you in, who's my client, are they going to benefit or not? from us implementing AI?
Yep.
Is this or is this not going to become cost prohibitive, et cetera?
So break that down by lender size, because there's a difference between what a big lender can do and how many tech people they can deploy on AI and what a small or mid-sized lender can do.
Right.
How do you think about that?
So think about the fact just how different expenses are for different size lenders. If you looked at, for example, even MBA research, right? They say that, the really efficient lenders, it costs them a little less than $9,000 a loan, right? And then they say the standard or smaller independent mortgage banker costs them upwards of $11,000 a loan.
That's a big gap.
This is huge, right? Very different on what you can spend. But when you boil it down to what is the actual profit they're making on a loan, if you look at what MBA put out this year, it was like $440 a loan.
Yeah.
Do you get excited about $440? Can you spend or do a lot with that? The answer is, how does it need to be deployed, and is that truly your net? And where can you cut your expenses? And I think that's interesting from a technology perspective. If I could make $800 a loan, if I could make $1,200 a loan with the tech spend, great. But do the life cycle analysis. On the stage with Sarah yesterday, I said, guys, your LO may be screaming, I need this technology. But if you really did the downstream analysis and you found that it's now going to take you 5 more days to close the loan, if you implement this, that same LO is going to be screaming, get rid of it as soon as you implement it.
Yep.
So you got to really look at what's that impact going to be all the way through your business.
Let's stick with cost for a moment, because I think it's a really interesting topic. I came into housing in 2018. But we've been digitizing mortgages for a long time, and the costs just keep going up.
Right.
What's going on? That should be
so
a
clearly we have
different
not digitized mortgage yet,
Yeah.
right? And look, I remember the rise of fintech. It was, call it 2015. Everything's going to be disrupted, et cetera. And look, I think there is a place where technology has enhanced, the manner in which mortgages are originated. But I also think that there are certain components of the origination that cost too much. Credit reports, great example. Appraisals at times cost too much. So it cost and time, right? You have to remember, when you're in a lender or you're in an aggregator, time is money. And you're paying all your people, and if they're touching the exact same loan over and over again, nobody's making money. And that really tight margin on my $440 example is getting smaller and smaller by the second.
Right. All right, let's pull out our crystal ball for this last question. What are you seeing, so uncertainty, volatility right now, we talked about that. What are you seeing as the issues that are going to be at the forefront over the next 1 to 2 years?
So I think some of the issues that we're going to continue to deal with over the next 1 or 2 years are issues that have actually existed for a long time. For example, most of the independent mortgage banker universe is beholden to an aggregator or the GSEs, right? What I want to see happen in the next year or two is I want to see them get their own liquidity.
Okay.
And we're actually focusing on that at Pivot. And if we can start to give those independent mortgage bankers true liquidity through securitization is a great example, now you start to level the playing field of mortgage. And no matter what happens with the GSEs, which, if you knew the answer today, great, because I don't.
Yeah.
Got a lot of, they can't make up their mind going on there. But, that will actually start to level the playing field, make it a little bit more fair. You'll see the margins on the revenue come up, et cetera.
Should the GSEs come out of conservatorship?
It depends on the day.
Okay.
I mean, no. And look, I think you have to be really careful when you answer that question.
Yep.
And the answer is, they can come out of conservatorship as long as it's not done badly.
Okay. What does doing it badly look like to you?
Doing it badly is doing it too quickly, without the right experts involved from the market, not really communicating, if there is an implicit guarantee or an explicit guarantee, not documenting it efficiently, and then everything gets a little haphazard.
Do you think it can be done in a way that rates will either stay the same or go down, or do you see rates going up?
Well, I think it's a little ridiculous that rates are fully controlled, call it by the 10-year and certain things anyway, right? And how quickly tariffs could play with your rates, right? I think that either could happen.
Yeah.
Right? I find it humorous that people are saying, oh, they're going to do an IPO for the GSEs. They're public companies already.
Right.
They're just in conservatorship. So why are we talking about we're taking them public? They're already public.
Right.
Right? So I think, we need to pay attention to the details, dig into them efficiently, and yes, then they could come out of conservatorship. But I do think that they also need to be regulated.
And one thing I admire about you is you really do focus on those details. I've seen those posts where you're diving in deep.
Yeah, and look, I think the reason for that is, and somebody said it really well on the stage today. I think it was Jennifer from Rate actually. She said, everybody just focuses on the headline, right? And the headline is not actually what should be driving your business. What should be driving your business is the details behind the headline. And you know what? If the headline is impacting 20% of the market, that means you have 80% of the opportunity left, and I think that's key.
Amazing, Jennifer. This is great. Thank you so much.
Thank you so much. I appreciate the time.